The International Energy Agency is warning countries are tapping into their oil reserves at a record pace because of supply disruptions caused by the Iran war. In its monthly oil market report, the IEA said the drop in supply will outpace falling demand. The agency says global oil supply will fall by around 3.9 million barrels a day for the rest of the year. It also added that more than 1 billion barrels of Middle East supply has already been lost. Well, joining us now from Brussels is Fredrik Erixon. He's an economist and director of the European Centre for International Political Economy. Good to have you with us. So when you look at those numbers that I mentioned, a drop of 3.9 million barrels a day in terms of supply in 2026, well, the drop in demand, much smaller, only 420,000 barrels a day. That is a much bigger gap than initially estimated, right?
Yes, that's right. So we are looking for sort of a 2026 where there's going to be a continued deficit in oil supply basically not meeting demand. And what the IEA is also saying in this report is that even if we sort of work with the scenario that the war is going to end and that traffic in the Strait is going to open up again, say, in the next month or so, it will take a long time for supply to recover and begin to be at levels where it's going to meet demand. That may happen sort of at first in 2027.
Are we seeing the beginning of demand destruction now, reading that report?
Well, I mean, there are two ways you can look at it. I mean, there is clearly a reduction in global demand for oil. And that reduction in itself can be forced, for instance, by reduced economic activity. So companies or households are going to demand less oil because they do not feel so they're able to produce competitively at the current level of prices that we have on the global oil market. But I think, and this is what also I would hope, is that the adaptation on the consumer side, both business consumers and finance consumers, that it's going to be stronger than we've seen so far, because at the end of the day, that's what we really need to do in order to avoid that we're going to have real problems and real economic problems coming from the oil supply crisis we have right now. So demand needs to be readjusted to supply levels. So that may sort of speak in favor of a scenario where you're going to find more households that are going to reduce consumption at the gasoline pump for this year. You're going to economize a bit more for when you're using the car, when you're using other means of transport. And hopefully
Fredrik,
that can be done without
that sort of, if we can call it easy, I don't know if that's the right term for it, but that sort of destruction of demand of retail individual consumer level is one thing. Do we know when that we might cross the line into a sort of industrialized side demand destruction where factories have to shut down, things which take a lot more time and money to get going again once you start to play with that sort of demand?
Well, it's already happening, but it's very uneven if you look at the global picture. I mean, we already have countries where you're basically going down to 4-day working weeks. We have a sort of a substantial amount of industries in Europe, in Asia, which are beginning to economize with fuel and look for sort of other types of not just temporary measures, but also looking at other more medium to long-term ways to substitute for having the oil supply. So demand destruction is inevitable when you have such an enormous supply glut that we have right now in the market. I don't really see how it could be anything different.
What does that mean for national GDPs going forward?
Well, I mean, if you look for this year, I mean, we're clearly moderating growth estimates for many of the major markets around the world. We do see still that America is keeping up. I think they still estimate to grow this year by 2.3%. Europe is already weighing down its growth forecast because of the increase in oil prices and the wider effects it's having on inflation and economic activity. But it's still a moderate reduction compared to pre-war levels of GDP growth. But if we go into, say, Q3, Q4 this year, let alone beginning of 2027, with a sort of supply glut still being there, perhaps even the war still lingering, then we're looking towards a 2027 and 2028, which is going to have huge consequences on global GDP.
Who's going to be hit harder, the global south countries or the north, developed countries?
Well, I mean, if you look, I mean, we do have a global oil market where prices are largely equalized across the world. So even if you're going to find that a country like United States, it has domestic capacities, autonomous capacities to produce, they're still affected by the increase in prices. But richer countries and more mature economies have access to more types of supply, and of course they have more substitution capacity generally in the economy. So the biggest hit is going to come on small emerging developing countries that are crucially dependent on oil for the general national fuel supply, not just for households, but for the production side, for businesses. So, Southeast Asia, Latin America, Africa, these are some places where we find the biggest effects coming so far, and it's probably going to remain that case also when we go into the autumn.
All right, thanks so much, Fredrik Erixon, economist and director of the European Centre for International Political Economy, joining us from Brussels. Thank you so much.